we are.
Great.
This is the first time we're doing this.
Let's talk.
We're talking.
All right.
We're talking the markets, and thanks for joining us.
Good to be here.
We're going to be kind of diving into something that's near and dear to our hearts, playing the long game when it comes to investing, and and kind of not getting emotional, not getting political, and why it pays to stay invested. So we're just going to spend some time on that here today, and got a few charts and resources to go through. As long as that sounds okay to you.
Good by me. Yeah.
If you have one of your signature jokes along the way, I think that would be welcomed.
I'll try to see if there's ever an occasion to bring anything up.
Yeah. Okay. Well, you've certainly got the majority of the brain power between the two of us. But I think, it would be good to just kind of start off with staying the course when it comes to portfolios. We manage portfolios for clients, and so often we try to get them to stick with an asset allocation that they're comfortable with, and a lot goes into that. The first thing I want to pose to you, just in your experience, is have you seen cases throughout your career? I'm sure you have, when clients have been unable to stay the course, and what kind of sticks out to you looking back over your career about maybe some events like that, and what are your takeaways?
Well, I can think of several. We're not a trust company, so we can't force our clients to stay the course. We have to persuade them, which means we can't always do that in moments of stress. I can think of several instances. Usually we are able to persuade them to stay the course, but I can think of several moments of stress where people have just capitulated to the pain of a down market. Probably the most vivid example in my memory is the 2008-2009 Great Recession.
Yeah.
Bear market, worst on record short of the Great Depression in the 30s. And I had a longtime client that I worked with. And remember, that was a grinding bear market. It took 18 months to go from the peak to the trough. And so you just feel like it's never going to quit going down. And he touched base with me several times along the way into what, and equities were down more than 50% from the peak to the low point. And he touched base with me several times, and I was able to persuade him to stay the course. But then in early March of 2009, which was the last week of the downturn, he finally just couldn't stand it and capitulated and had me move him to cash. He was within about 3 or 4 days of the bottom of the market. And then it turned around, and we had a pretty sharp recovery. But that's, when you've just exited the market, it's extremely difficult emotionally to say, oh, I was wrong, I better get right back in. People just don't want to do that. And so they'll say, well, this is a dead cat bounce. It's not really going to come back. I'm going to wait. Well, it didn't come back and test those lows. And so the end of the story is he slowly got reinvested. But
would have been better off if he just stayed the course.
Probably $1 million better off as we sit here today. The happy ending to that is that he has enough money that it didn't really change his life.
Thankfully.
But
I'm sure there are some stories where there's a lot.
He kicks himself certainly for it, and
I'm looking at this chart from COVID, and we were chatting about this morning, and from the market bottom in 2020, this just really tells the tale, doesn't it? I mean, if you just were in a 60-40 allocation, stayed the course, stayed invested, $1 million, at the bottom would have been maybe 800,000. That feels really scary. But if you just stayed the course out until the end of 2024, that value's back up to 1.4. Yeah. If you just stayed in cash, you would have earned kind of a market rate of interest. You're basically flat. And then, if you said, no, I'm going to go into fixed income, I'm going to sell out of my allocation, go into fixed income, you were 21% worse off.
That backfired, because we had a bad bond market following in 22. And I think COVID, in a way, is a very compressed example, and and in some ways doesn't emotionally test people the same way. The market declines so fast and then turned that a lot of
So
people
fast.
had no chance
Yeah.
to react and get scared.
Yeah.
And they saw it coming back, and that saved them. I think the grinding bear markets, like, early in my career, 73, 74, 08, 09, those are the ones that just beat you up
Yeah.
and test your emotions.
For sure. Kind of just stemming off of that, how important is it to help maybe even just new clients? People come and they interact with us. How important is it to help new clients find an allocation that they can stick with? We've looked at kind of these last couple of bear markets, and those show us how important it is to stay the course. But how do you do that?
Well, as you well know,
How important is it?
our course with clients is to really work that through the investment policy and plan that we set for them on the front end. And it's not a question of if we're going to have the bad markets, it's just when and how severe they will be. And so we test that through a lot of historical and Monte Carlo type testing to figure out, will your allocation work? And the key is for us to get the client's mind wrapped around the plan so that they believe in their own plan.
Yeah.
And if you believe in your plan, then you can stick with it. But
I think education, too, is crucial. You have someone who hasn't followed the market their whole career. This chart from Vanguard, someone who's 60-40, who's pretty, balanced, moderate. It's important at the start to say, hey, we might have a down year of 26.6%.
yes,
It's possible you could have a drawdown like that. That's kind of the max, drawdown, historically. It's also possible you could have a 36% year, looking back historically. So these kind of bands are really helpful to educate investors.
and I think we try to do that, and it's important for clients to realize that's a drawdown from the market going down. Remember, if they're retired and they're living off the money, they're also withdrawing when that's happening. So their decline in account value is really even more severe than that. And so I think a danger that a lot of people have, we as Americans are kind of programmed and trained to say, well, we're risk takers. I'm not going to panic. I know I've got to stay the course.
Yeah.
That mantra has been beat into people.
Yeah.
And so a lot of times folks walk in the door with us and they're saying all the right things. Our job is to paint the picture in dollars and cents and say, this is how painful it might be at an acute point in time. Let's make sure that you can really live through this.
Retirees, too, if you think about it, they can at times come in overconfident, right? Because all the times they've stayed the course have been when they're earning a paycheck. They've been at their 9-to-5 job. They've been saving. They're not living off the money.
Not living off the money. Right.
And so I think some just kind of recalibration there is good.
Yes. Yeah. It's a different mindset when you're living off the portfolio.
For sure. Yeah. Well, you've never darkened the door of a casino probably in your life, but
I have.
But we do talk to some people at times that think the stock market is like a casino. And really, I love this chart that that we've looked at previously, but really it's quite the inverse. The longer you're in it, the better your odds are.
That's the exact opposite. I mean, everybody knows if you go to a casino, and I've always heard the best odds are to go to the blackjack table, but if you play long enough,
there a long time,
you're going to lose money.
That's
you just
correct.
keep repeating and playing long enough.
Stocks work
the market
exactly.
is the opposite of that. The longer you play, the more the odds shift in your favor.
I mean, do you think if we looked at this chart and told the average person that, hey, 8 years out, rolling returns, looking back at history, 97% of the time, 8-year rolling returns are positive in stocks. Do you think most people would believe that, or
no? I think they'd probably have a hard time, believing that. But those are the facts, and I think. The other real disconnect in people's minds between thinking of the market as a casino is that you got to remember when you're investing in the market, if you're investing in solid companies that have real economics behind them, these are businesses. They've got sales, they're generating profits, they're growing.
Yeah.
You own an asset that is growing in cash flow. That's not That's not random. That's not like a casino. A casino is purely random.
Yeah.
So it's, the odds, the longer you're in the game, are shifting in your favor.
Yeah, absolutely. Well, let me get to kind of maybe a little bit of a hot button topic: emotions and politics.
Yeah.
For people who are invested in the markets and maybe are retired and like we've been talking about living off their money. We were looking at this. This is just a chart of the S&P 500. And we like to call it "Don't get emotional." And it just overlays only owning the S&P 500 after its up days in the blue, only owning it after its down days in the green. And what it shows you is that the market does very well after the down days. And so,
a lot of times the very best up days come near, after
Right
the
after.
market's been wrung out.
Yeah.
And so if you're disinvested when it goes down, you're going to miss those sharp up days.
I'll put something maybe funny to you here out in public that maybe you don't want to answer. Have you ever sought to buy the market after down days? Do you have any horror stories or positive wins or in your personal portfolio?
Yeah, no, I'm not a great person to ask because I can attest I really have never chickened out and gotten out of the market. So it's not like I've got a bunch of cash. There have been a few occasions when the market happened to be down that I might have some spare cash. And yes, I've put it to work, either in individual stocks or in the broad portfolio. But really, in my case, that's just a small amount at the margin because I have really come to believe and accept that the thing to do is to remain invested. I think that's your whole point here, and certainly consistent with our philosophy at Precedent, in terms of how we're managing portfolios.
Yeah. How hard is it to convince clients after a COVID or an environment like '08 or whatever to, if they're holding cash to buy the market? Have you?
I think we've had some success with that. The distinction I would make is that our success in getting people to expend some cash when the market is sold off is more with clients that have been with us for a while, who have lived through some downturns and seen the recovery. I can think of one of our clients, the one we refer to, who kind of lives off the grid up in the Northeast, and he was very conservative. Northwest, yes, when he became a client. But now that he's lived through a few of these, he's become opportunistic. and when the market's down, he wants to take advantage of it.
He's one of our favorite clients.
Yeah, with cash.
He's looking to...
He knows who he is.
He knows who he is.
But no, I think it's the newer client that's wading into the pool from the shallow end and not as experienced, that has a harder time believing you when you say, boy, this is sold off. You ought to plunge some cash in a little quicker.
Yeah. Well, we saved the best for last.
Okay.
Don't get political.
Oh, yeah. Right.
Which is always a fun topic. But, I know we're probably going to show this chart on the screen, but I love this. It really just illustrates $1,000 invested in the S&P 500 since Eisenhower was inaugurated in 1953. Okay.
Yeah, I was there at the inauguration.
Yeah, you might have been there 50 or 75 years sooner.
I was born.
Yeah.
I wasn't there.
Civil War, I think, was your date.
All right,
birth,
now you're getting the jokes. Okay, go ahead.
But look, the left side shows if you were only invested when a Republican was president, the red bar. The right side shows if you were only invested when a Democrat was president. And that just shows the growth of $1,000. As only investing in Republican presidents, you have $27,400. Whatever, 70 years later.
Yeah.
If you're only investing when Democrats are president, you have $52,000 70 years later. If you just stayed
invested
and did nothing, you'd have $1.43 million.
Yes.
73 years later.
That's the moral of the story.
Right. I mean, I think the chart tells it all. But my question to you on this is, obviously we know, don't get political with your portfolio. Try to ignore it. Again, like you said before, look at companies that have solid cash flow and are growing their earnings and, that you feel optimistic about, have solid balance sheets, all those things, right? But how have you seen things change more recently relative to earlier in your career? I'm thinking of social media.
Yep.
I'm thinking of, even the popular news channels really being entertainment channels or sites and not, you almost can't get an objective source of news in this day and age. Do you think it's harder to not get political now than it was, say, 30 years ago?
Yes, I do think that, because we are in this. I don't think it's any secret to our viewers that we're in an extremely partisan environment. It's very divided, and essentially between the blues and the reds. And I mean, I can think, and that's been the case really for 15 or 20 years, now. And I can think, for example, in 2016, I can remember a client of mine when the election results were in and Donald Trump really achieved an upset over Hillary Clinton. One of my blue clients called me the next morning, and his words were, "This is a disaster. We need to meet.
What's the move?
You need to tell me what we're going to do to protect." I mean, he had all these visions of how terrible it was going to be, and I was able to talk him off the ledge, okay? And he remained invested, and ironically, he sent me an email exactly a year later. I had forgotten the conversation. He sent me an email and said, "Hey, I just want to thank you for convincing me a year ago not to bail." He said, "I don't like Donald Trump, but I sure like the way my portfolio is looking," a year later. And then in 2020, when it went the other way and Biden took the presidency away from Trump, I had an absolutely identical call from one of my red clients who said the same thing.
Yeah.
This is a disaster.
It's over.
What are we going to do? We need to meet. You need to tell me.
We need to go to cash.
Yes. And again, we were able to persuade him not to panic and not to bail. And he's, immensely wealthier today, remaining invested through the 4-year Biden administration when the market continued to advance. So, but I think the reason for both of those incoming calls is that people, we get our flow of news through filters today. There's virtually no other way to get it.
Certainly.
And you generally get it through a filter that you choose and prefer, that filters it the way you would like to see it. So that all magnifies.
You do think it's harder now?
The narrative. It's harder
I think that's true.
to keep yourself anchored to the fact that, look, the economy is not all about politics, and the economy's filled with people that are both blue and red, but they're all getting up every day, going to work, figuring out how to make a buck, how to make their companies more profitable. Yeah. And if they're successful doing that, and American companies have been very successful at that for decades, they're growing the value of those businesses. Yeah. And they're going to increase in value as a result.
Let me close with something off script just based on what you just said. Let's, some presidents are in office or administrations, whatever, for 4 years, some are in for 8, right? So let's just go back to this rolling returns chart. Let's take 6 as an average. How does that sound? So those companies you were just talking about, over a 6-year period, over the last century or so, rolling returns are positive 94% of the time.
Those are hard odds to beat.
If you just kind of average out the average administration's time in office, that's it's pretty positive.
It's amazing to me, and I'll just throw this in closing, how many people come to us that are, they're very smart in whatever they do every day, and maybe they've monetized, the sale of a business, or they've retired and they're taking their, their lump sum on a pension or a rollover from a 401k, and they've gone out and gone to some seminars, and somebody has convinced them. We've figured out how you can time the market, and it's incredible to me how very smart people will just fall into line because somebody shows them a back test. It says, look, if you had just done this, you avoided all the downturns and you captured the upside. Look, every back test is going to work. That's by definition, okay? So forget back tests. They're irrelevant. The history on market timing is, when you back test all of it together, it's lousy.
Yeah.
The odds are against you.
Yeah. Well, thanks for your time.
Yeah.
It's good to chat about the markets, and I know we're not intending any of this to be actionable investment advice, and just trying to get some of our firm thoughts out there. And
I think
guess
our,
we're gonna
our philosophy, I think, is well articulated though in the conversation.
We're gonna have to probably come up with a name for these as we go along.
Well,
and,
I'll leave that to you, smarter people.
It's one of our first ones here, so we're just over time we'll make it more official. We'll get with our video team, in the back office
our gurus,
smarter than us with all this stuff. But thanks for joining us.
All
here,
right,
and glad we spent the time.
We're Precedent Wealth Partners. Let's talk.